presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for November the 1st, 2022. I'm Mo Ansari, President of Compak Asset Management and host to Market Wrap. Let's take a look at what the Fed is going to do this week. That is the big question tomorrow. What is the Fed going to announce? Well, just about known. It's 86% probability that they're going to increase interest rates by 0.75%. But what are they going to say? That is more important. The market, well, we had a wonderful month in the market. How are we looking for November? We'll take a look at that. The economy, the weekly technical analysis, the market, where we are as far as how positive or negative I am, and outlook for the week ahead. So let's start with the Fed. This week is the FOMC meeting. The time period since 1980 duration when the Fed is increasing interest rates much faster than in 2022 than historical hikes. Well, I don't know. In the 1980s, Volcker raised interest rates at the rate of 2% per interest rate increase. So from 1988, yeah, it's been slow, but if you go from 1990, the rate increases have been pretty high. Inflation at the start of the Fed rate, again, we are going to the 1988. We go to the 1970s. I know some of you remember it. I do. Inflation was a lot higher than the 6.77% where we started this time around. But we are seeing that the Fed balance sheet is starting to decline. These are asset securities held outright. U.S. Treasuries are starting to sell those off, and you can see that they've sold off some of the treasuries already. The same thing with mortgage-backed securities. They were selling those off a little bit, came down, but now they've sort of stopped selling those because they're worried that the interest rates might go up too much on the housing market, and that might create a problem in the housing. Well, I think housing is going to slow. The question is by how much. It has already slowed down. Just like the stock market is going to slow. Well, it has already slowed by 25%. It's come back up. It's only down 19 now. The S&P and the Dow is down about 10% for the year. But I think we are going to continue to see volatility. So what the Fed decides tomorrow and what they announce is going to be a big deal. The market is expecting that the Fed is going to, or Powell is going to say that they are going to slow down the interest rate increases. I don't think the Fed is going to do that. They're going to raise by 75 basis points. They might only do 50, but they're not going to telegraph that at this time. They want to keep the pressure on the economy and slow the economy down. As far as the economy, it is slowing, but not a lot. If you look at the number of jobs that came out today, it went up, the job openings. That means there are more people, there are more jobs than people looking for jobs. And as long as that continues to happen, wages go up. As long as wages go up, inflation stays high. So the Fed at this point, I think, is not seeing enough economic data to slow down, even though they're front-loaded the interest rate increases. I still don't think they see the slowdown yet. It's going to come, and the Fed always overdoes it. Can they calibrate it just right, where they back off just before the economy starts to slow, and then it sort of slows and comes back up? Or do they raise the interest rates too far, put the economy in a recession? And that's what historically they've done. We'll have to wait and see if this time around how they work. And tomorrow, I believe the market might be a little disappointed, and they're not going to get the dovish pivot that people are looking for. Looking at the high yield credit spreads, those spreads have come back up a little bit, but not much. We're nowhere close to what we saw in 2020 or what we saw during the financial crisis. 48 years ago, the market waited till the peak inflation before it rallied. This is peak inflation right here, and this is where the market bottom, came back down one more time. Didn't make a new low, but then it took off once we saw inflation peaking and starting to come down. Has inflation peaked? It looks like we have. Value stocks are starting to outperform. Well, that is no secret, and small caps will outperform large caps when we see the turnaround. Usually when they see the turnaround, we see a lot more bounce in the small cap stocks. Looking at the economy, inflation looks like it might have peaked. and it's starting to roll over. This is, you can see, this is the United States. It has topped out, starting to come back down. You can see the green is the UK. It topped and started slightly come down. EA is not yet, but I think it will. So inflation may peak, but we want to make sure it comes down faster. That's what the Fed wants to see. 8% CPI, I don't think is acceptable. It's coming down very slowly, and the Fed wants it to come down much faster. As you can see, wage growth peaked right here. It's starting to turn down. But as long as we have two job openings for every one person looking for a job, I think that is going to be a problem, and wages will stay high. They're not going to come down as quickly. CPI expectations, you can see this is the forecast that is going to come down quite a bit. We'll have to wait and see if that happens. Housing demand, this is weakening as the mortgage rates climb. You can see the mortgage rates are going up. The housing demand is going down. I think this will continue to be the scenario for real estate, but we've had such tremendous appreciation in real estate over the last couple of years. So I don't see why we can't get a 10-15% correction in prices, if not more. And that would not be surprise me. The go-go days of real estate are gone, where people are getting 19 offers on every house they had on the market. Consumers still resilient due to excess savings. You can see that the amount of savings that people have, this is in trillions of dollars. You can see that we're still sitting at about $1.5 trillion in savings. Granted, most of that is in the top quartile. These are the people who make the most money. Well, they obviously have the most money saved up, but I don't think their spending depends on how much they have in savings. Their spending has remained sort of constant. Yes, they were not able to travel and take the vacations that they usually do in 2020 and 2021, but now they're starting to come back to the normal pattern. The big changes are at the lower half, at the bottom quartile or the third quartile or the second quartile. Those rates savings are starting to come down, but still a substantial amount, a $950 billion still there. Don't forget, you can listen to a daily edition of Market Wrap. Simply go to the App Store and type in Market Wrap with Mo Ansari. That's Market Wrap with Mo Ansari, and you can get the free app and get the free full 1-hour edition of Market Wrap on a daily basis directly downloaded to your phone. Looking at the technicals, this is the only thing that I'm looking at that worries me a little bit right now. We're only seeing a third wave top in rates, and rates are expected. The fifth wave projection, we've seen wave 3, everything moves in one wave up, 2 down, 3 up, 4 down, and then 5 up again. That's historically the pattern. So we're in wave 4 right now, which is back and forth a little bit, came down here. But if we go to wave 5, which is coming around here, 4.6 to 4.7, and right now we're at 4%, I think the market is not ready for a 4.75% 10-year note, pushing 5%. That'll depend, again, and if inflation comes down, that'll depend if unemployment goes up. That's why I think Friday's unemployment number is going to be much more critical to watch and see how that comes out. If that shows that less jobs are being created, that would be bad news is good news for the stock market, and good news in the economy is bad news for the stock market. So it's just inverted right now. S&P looks like it made a fifth wave bottom. That's usually the end of the cycle. Wave 1, wave 2, wave 3 we're in. This is the 20-day moving average, 38.29. We closed at 38.59 today, so we're above the 50-day. The next resistance is this gap right here, and then it's 4,100. That's really where we come down to, plus or minus. That's the 200-day moving average. The long term, as you can see, we have not really broken up above the 200-day moving average in a long period of time. So we need to get above 4,100 to return the long term turns up. But this is wave 1, 2, 3. Then we get a fourth wave pullback, which I think we could see if the Fed does not make everybody happy today. And the market says, oh my God, the Fed is going to continue to raise rates. They come to that reality. We could see a little bit of a pullback over the next few days, but I think the critical number is going to be the unemployment data that comes out on Friday. Looking at the weekly charts again, this is the 20-week moving average, 39.09. We got as high as 39.11 today, but then we fell back down, closing at 38.58. So I think 3909, 3900, if we can stay above that, and then 3910 or so, stay above that, and then 4100 becomes really the target for the S&P. NASDAQ came down, made the ABC pull back. We've seen the market come down here, pull back here. Now we are still below the 50-day moving average, which is 11,250 or 10,895 today. We made a high of about 11,150. That was the high today. So we need to get above 250 or the 50-day. If we can do that, then we again start looking at this gap right here, which is somewhere around 12,000. And then the 200-day at 12,356. Weekly, same thing. We need to get above 11.2, then 11.5, and then 12.7. Those are long-term numbers. And the market is sort of sitting around, going back and forth. NASDAQ has not really done as well as the S&P and the Dow, which is usually not a good sign for the stock market overall. Crude oil is all dependent. Today we did see a bounce in oil because of Saudi Arabia putting its troops on alert, expecting a drone and missiles strike from Iran into Saudi Arabia, and that put the U.S. forces in Saudi Arabia also on high alert. Again, a week ago, the Saudis were saying, look, we're with the Russians. Today, when the Iranians came knocking, they were calling on the U.S., please save us again. So we will see how this plays out. I think this could be just rhetoric on both sides. But oil is moving on fundamentals, what is happening in China, what is happening on the economy around the world, and that as the economy slows down, the demand for oil goes down. The gold market did go all the way up to the 50-day moving average, 50-day right here, failed, came back down at the beginning of this month, made the low. I was looking at a low of somewhere around here of about 16.15. We made a low of 16.22 right here, bounced back up, but I still see the path of least resistance in the gold market is to the downside until we see the Fed backing off. I think the market has rallied nicely. I want to get more confirmation that the market has made a bottom. If you're all in, all out, then you're chasing and wondering if that was the bottom. Now you're wondering if you should be. That's why you don't want to be all in and all out and play poker with your financial future. What you do want to have is a balanced portfolio that creates wealth over a period of time. And even though if we've seen a pullback this year, it's not dramatic. You're down maybe 10, 12% in your portfolios, and you're okay if you have a balanced portfolio. But if you're down 30, 40, 50%, you have a problem. That money is not coming back. Looking at the market, I think we're a little bit more positive this week, so a little bit more excited, but still want to see above the 200-day. Again, don't forget to sign up for my Market Minute. That's the weekly newsletter that I write. You can get a free edition. Simply go to marketwrapwithmo.com. You can go to all the insights. You can see all the events. You can see all the charts. And you can just click on the link below. Looking at the week ahead, I think this week is going to be critical, and that will really set the tone for the rest of November. How does the unemployment number come out? How does the Fed, what does the Fed do? What does the Fed say? That's going to be much more important. Those are my views. Those are my thoughts. What I'm looking at on November the 1st, 2022. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.